Hi, this is Rowland from Money and Markets TV. Some investors try to profit from all the ups and downs in the stock market, and others go to the other extreme, ignoring current events and thinking long term. I believe the best strategy is somewhere in between. In volatile markets like these, it's important to take a step back to get some perspective. But you don't have to step back too far. For example, if you review the market action for just the past year, you'll get some valuable insights. Namely, you'll realize that one sector is having a disproportionate impact on stocks. That sector is financial services. That shouldn't surprise you too much if you've been following the market closely, but you may be surprised at how well other sectors of the economy are performing. You can get a good overview of the market by looking at the performance of the SPDR S&P 500 ETF. Over the past 12 months, it had a total return, including share price plus dividends, of about 8%. That's right in line with the S&P 500 index, minus SPY's tiny expense ratio. But if you break the numbers down using SPDR's Select Sector ETF family, you'll see big discrepancies in their performance. 6 of the 9 SPDRs had 12-month total returns better than the 8% of the S&P 500 ETF. Energy, utilities, consumer discretionary, consumer staples, healthcare, and technology all managed to beat SPY, and energy in particular had a great run. On the other side, industrials, materials, and financials all lagged the weighted average. Industrials underperformed for the same reason energy did well: higher energy prices. XLI includes airlines and other transport stocks that suffer when fuel prices go up. Materials is a relatively small sector with limited influence on the broad market. Some of the mining and agribusiness stocks had impressive returns, but losses in the steel group kept XLB below average. The financial sector, as defined by XLF, includes large cap banks, insurance, brokerage, and related companies. Few members of this group did well in the last year, and some big names performed horribly, including Bank of America, Goldman Sachs, Morgan Stanley, and Citigroup. Not so long ago, a portfolio of these stocks would have been called blue chip. Some may have even considered it conservative. Now, not so much. Of course, I'm not saying that everyone should abandon financials and embrace energy. In fact, statisticians will tell you that performances that are this far above average and below the average as energy and financials are unlikely to be repeated. My point is that in order to have success in the markets, you don't have to identify just the winners. You also have to avoid the losers. So over the past year, you would have done pretty well with a portfolio comprised of every sector except financials. As for the next 12 months, we don't know yet. Much depends on the outcome of Europe's banking crisis and the global economy. But you can improve your odds of success by keeping an eye on sector ETF action. I'm Ron Rowland from Money and Markets TV. Thank you for watching.